Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest is Marcin Drozdz, and we're talking about raising capital today. So if you've ever asked, how do I find investors for real estate, whether you're starting out, starting over, or looking to scale to 7, 8, or even 9-figure business like Marcin did, there's valuable lessons in this conversation where you can find out how to find investors right now. This is episode 298 of Zen and the Art of Real Estate Investing with my guest, Marcin Drozdz. Marcin is the managing director at M1 Real Capital, where they've raised multiple 9 figures across 8 funds focused on distressed and value-add acquisitions in the U.S. In 2021, he also launched M1 Inner Circle platform, which has helped over 400 operators, fund managers, and capital allocators scale their pipelines and close bigger deals. Marcin, welcome to the show.
Thank you, sir. Appreciate the opportunity.
Yeah, I'm excited to talk to you. And like I said, we're closing in on episode 300, but every episode is different. Sometimes I start in the background, but I want to start with one of your areas of expertise. It's about capital raising. For somebody who is just about to raise capital for the first time, where should they start? And what's the most important trait that they need to have to start that hopeful snowball going?
Yeah, it's a really good question. I got to update my bio. Actually, we've had over 1,000 people go through our M1 Inner Circle at this point because it's been it's been a snowball in of itself. Right?
Yeah. So same principles, though, right?
Yeah,
I mean, building that out.
Yeah, and I'm sure we'll dive into, I have a concept called your unfair advantage and things like that. But just to answer your question kind of head on here, I have a framework that I teach called the 3P framework. And most syndicators do it, but they do it backwards. And what do I mean by that is that the way most syndicators do it is they focus first on the property or the portfolio. Then they might focus on the process that they go through, value add, or whatever, the different ways that they do stuff. And then reluctantly, maybe they'll mention the people that are actually involved. It's kind of like one of those things where you're like pulling teeth, like, oh yeah, we got these people involved, right? I actually do it in reverse order. So literally I first start with the people as the primary point of contact and curiosity, which is why the unfair advantage is so important, because ultimately people invest with people. And that is the most important thing, is the relatability of the people that you're actually investing with. And we can dig into that all you want. And then I actually focus on the process that you're involved with. And it doesn't have to be like revolutionary, right? It doesn't have to be like you invented value add or whatever, but it's about
nothing's
how you
that new.
Yeah, exactly. I mean, real estate's kind of been around for a few thousand years, right? So it's a way of, how do you frame what I call your unique method? So your unique way of doing things, which is something we can talk about after. And then finally, once they buy into your unfair advantage and your unique way of doing things, your unique method, then the portfolio or the property that you're actually buying makes a ton of sense.
Yeah, I love it. And that's the way I was trained by my dad from literally the time I was a kid. But I mean, for everybody out there, once you lock in the people, those other 2 Ps, they're still relevant. But once you have built that trust with the person, they're already so much closer instead of going the other way, like you said.
Yeah. And so the question is, how do you build that familiarity with people, off cold traffic? And again, 10, 20 years ago, it would have been, in person. Today, it's so much more online and whatnot, which is fine. But the first principles are still very much the same. So just to give you some context, I started in this space about 20 years ago. And my first client and the first person I worked with was MC Companies, Ken McElroy. And we'd raised about 300 million for them. Now Ken's obviously got a big brand today. That wasn't that really wasn't the case 20 years ago. I mean, there was a brand, but it wasn't the way it is today, right? MC companies, 2 billion AUM, things like this. But 20 years ago, it was, we focused on the people, which was Ken and Ross. At that point, MC companies was only a couple of years old. And we really leaned into Ken's expertise in the property management side and Ross's and acquisition side. And Ross McAllister, his partner, hence the MC, we leaned into his expertise on the development side and the building side because he was a youngest banker of a state bank at the time and really good on the financing side, general contractor. So between the two of them, we were able to tell the story of why they came together, how they did it, and then getting into their process of back then talking about buying and refinancing large commercial assets. I know today it's kind of like, duh, but 20 years ago, this wasn't like a
I know.
mainstream
Yeah.
concept, right?
Yeah.
So when we talked about the idea of an infinite rate of return, once you did a cash out refi, people's minds were just like, right? Once we did the team, the people, and we talked about the process to get them to the infinite rate of return, it was like, okay, so which project? Well, we have this one. Okay, boom. We have this one. Okay, boom. And it was we did $300 million in like 24 or 28 months.
Yeah, well, I'm sure you did it though based on one smart presentation of their backgrounds, which already both had track records, and I think that's what people need to look for because now, as we were saying, less social media to none. Then now everything's on social and clips are 9 seconds instead of, an hour presentation where people can really be wowed in person. So it's kind of a different avatar, but I still prefer the old way. And I still think what you're saying based on everything that I've read in my research, it's the relationships are the key. You may be building them a little bit of a different way than you did 20 years ago when you were doing it there, but the principles are still the same. And that's what starts the snowball to the long-term relationships where you don't have to be chasing forever, right?
Yeah, I mean, Jonathan, you got it because whether it's newspaper ads or yellow pages, and some of you are like, "What's yellow pages?" And that's a different conversation
those young kids.
But I still remember that, or LinkedIn, or social media, or these podcasts or live streams. Ultimately, people haven't changed all that much. How we get information out has, and that's really the difference. And you probably see it. I definitely see a fair share of it online. Is when people, especially newer people to real estate, they're like, but it's like a 19% IRR, and here's all the things, and here's what's going on, and they're missing the point of how money is actually raised, right?
Yeah. Well, I mean, your background in relationship building goes back to you like at 10 years old or so, building all of these businesses as a kid who was just kind of new to Canada, right?
Yeah, well, yeah. So I'm happy to share that too. I grew up I was born in communist Poland actually, and my dad got arrested when I was a young man. I was a couple months old. My dad was smuggling corn with a C into the country, and
I was like,
not because it sounds like other things, but no, it was corn, like food, right? And you're not allowed to have a business, so they were going to put him in jail for 10 years or the military for 10 years. He didn't like either, so they ran off to Eastern Europe, and eventually we applied to U.S., Canada, Australia, everywhere, but Canada responded first, so we ended up in downtown Toronto. And yeah, I mean, look, you just show up and you have no plan B. So mom and dad are working, and I'm running a little garage sales. When my mom told me that I couldn't sell stuff from the house anymore, I was like, okay, I guess I'll do something else. And I started having newspaper routes, and then you start selling chocolates, you just start doing stuff. You just figure things out. And then to your point, I realized that whether it was golf balls or newspapers or chocolates, if people genuinely liked me, they would be more receptive to actually seeing what I'm doing, right? So.
Yeah. Yeah, I mean, it's just an interesting corollary over all these episodes and so many entrepreneurs that I've talked to. The spirit of entrepreneurship, you see it a lot when people were younger, what they did to make money, whether their parents were supportive of that, where they came from, if there was a scarcity mindset that made them really want to get after it. And these are all things that I think were part of it for you. But it's interesting to show, like just what we're saying, even the strategies that you used back then, they're still relevant now. They're just relevant on a much larger scale because your end goal is not, 3 newspapers. It's $1 billion sometimes.
Well, it was funny as I was always trying to find a way to create urgency and scarcity, but like legitimately, right?
Yeah.
So I purposely, whenever I left the house with a bundle of papers to sell, I'd only leave with 10. So I would always say, well, I only got 5 left. I only have 3
Yeah. And it
left,
was
right?
true.
So
Yeah.
it was true. I wasn't
Yeah.
lying. I just had to go all the way back to the car and get more
Yeah.
papers, right? So, but I would never carry 50 with me, because if I carried 50, I would never sell any.
Yeah. Yeah. And I mean, urgency is a part of large scale, acceptance of money and capital raising, because there is a finite seats available when you're good at it, right? And that means you have to be good with your old investors. You always want them to keep coming back to the trough, but there's always a time for new investors. How do you judge that along the way as kind of who's the right fit for you? And I'm sure it changes at different parts of your cycle in terms of who you have availability to get.
Yeah, I mean, you always want to have a good disciplined capital raiser or allocator, fund manager, or whatever you want to call it. In your mind, I always want to think about like a third of the capital up to half the capital coming in from new sources, just because, what that does is it keeps you sharp and it keeps you open to new relationships. If you ever get to a point where you're like, oh, I got this, my network got this, oh, I got this, my network
Yeah.
got
Yeah.
this.
Wait till one bad
Eventually,
deal.
yeah, what eventually ends up happening is you then start to lean on that network for everything. And as you want to grow, that capital base hasn't grown with you. And I see it with our clients all the time, and we consult on a lot of different files, and I see it. Some people can typically get that. Depends on the network and who's in your circle, so to speak. But everybody, once they hit that wall, whether it's at 3 million a year or 10 million a year, you hit that wall of what your world can kind of sustain. And, if you want to venture outside of that, just having a good mix of new and existing for every opportunity is a healthy way to kind of position that.
Yeah, and I wanted to go back again, though, because I want to just kind of help people who are newer to capital raising and then get into the nuanced details of what it takes at the larger scale. But really, your first pitch was to your parents. You're like, I got to get this money to get it running. But then when you did your first house flip, were you doing that with your own money with you and your friend, or did you need to
Yeah.
pitch someone else to get money? Because I feel like people in the beginning, sometimes, especially now, I think they're asking for money too early. They have no proof of concept, and they're
Yeah.
they're out there too early. What advice can you give them based on your history of starting so young?
Yeah. Well, first of all, capital raising is a regulated activity. So make sure you hire a securities attorney, because you don't want to mess around with this stuff. And I know that. Just want to make sure that the
Yeah,
audience listening to
absolutely.
this is aware of that. You don't just run around and unless you go to the bank of mom and dad, if they want to write you a check, I'm sure that's
Yeah,
fine.
well, yeah, that's
Um,
easy, but not
yeah,
so much on the back end. Yeah,
no, well, it's a different story.
yeah,
But yeah, so in the first, we did a bunch of flips, me and my best friend, and I guess that was a joint venture. You
yeah.
know,
All right,
theoretically, you're both supposed to bring money and talent, and both of us brought money and no talent. But we,
kind of classic first house
we,
flip, right?
yeah, yeah. But despite our best efforts to screw it up, we actually made like 30 or 40 grand, which was, I guess I was hooked. But no, when I look and when I started getting into larger stuff, I knew that I didn't know, right? So, and that's really important, just to know what your limitations are. So, and to your point, Jonathan, people come to us sometimes and they have no experience, like I mean, like business experience and no real estate experience, and they want to raise money. I'm like, listen, like go mentor under somebody, go learn, go work for free, go get a job, even or something for somebody under someone's wing. I mean, that's what I did for the first couple of years. I made the comment, we raised a fair bit of money for MC companies. I had no business doing 300 unit apartment buildings back in '07, '08. I was just like, man, that's like a lot of toilets. Like I had no context, right?
Yeah,
So I was fortunate. I got to be mentored and learn from guys that, had already been successfully operating at that point, and actually spending a couple years there, really refining my skill set and understanding all the legal, the how to read financial statements, how to understand capital raising, capital formation, the capital stack,
yeah,
like all of these different nuances, common equity, pref equity, sub, senior, mezz, like junior, like just understanding all of this different stuff, difference between audited financials, notice to readers, reviewing, like there's just so many, like death by like 1,000 paper cuts if you don't know what you're doing, right? So I drank from a fire hose for a few years, and in hindsight, I probably should have stayed at the PE firm longer. But as in my early mid 20s, I'm like, yeah. After a few years, I'm like, yeah, I got the gist of this, and
yeah. Right.
I didn't. But when I left, it took me a year to figure out what I didn't know that I didn't know, before I could actually launch my own fund. And then, I finally did launch my own first fund. It was an 8-figure equity fund. It was 2010, 11. But again, on the operator side, I partnered with an established operator, and I brought in the governance and the structure and the equity, and I built out the balance sheet, so the fund, so that we could then go and buy. We were buying medical plazas, and so it was like retail plazas, like strip mall style, 30 to like 50,000 square feet. And the kicker was that they were 2/3 empty because the world was still a really bad place back then, especially in Arizona and Florida. But the medical tenants, the prosthetic limb manufacturers, the people that were paid by Medicaid, Medicare, they were still in business. They were getting
Right.
paid. So we were buying these malls 2/3 empty, but it was great because we bought them for nothing, and there's that one tenant that was still
Right.
paying the bills.
Yeah. Yeah, it's smart. I mean, I've seen that a lot now in office. People think, oh, wow, there's no cars there. And it's like, well, the banks are still paying. Like the
Yeah,
land, the,
well,
the owner's doing okay in a lot of senses, but it doesn't always work out.
yeah, yeah. But my point was that to answer kind of your question is that I wouldn't have been able to have even established myself as somebody worth partnering with that experienced 9-figure operator had I not done the thing where I was just literally a cog in the machine, adding as much value as I possibly could, working all the roles that anyone asked me to do and more, just to get in the room, to have the experience, to have the context, to be able to do other things after.
Yeah. I mean, do you feel like the newer generations that are hitting into the cycle are less willing to be that cog in the wheel? Because that's what I'm seeing a lot. It's like they want to get to the high-end capital raising too quickly, but there's a lot of punches you need to take along the way to make sure that you've earned that reputation to ask.
Yeah, and I agree with you, but I also don't think it's their fault entirely because we're sold the world 9 seconds at a time on our
Yeah,
phone.
exactly. Yeah.
So, they make it look, especially these like 30-second like reels or whatever, and they walk you through someone's entire life journey in 30 seconds and like, do you want this? Well, yeah, of course I want this. Well, okay,
Right.
this took
Right
20
now.
years, not
Yeah.
30 seconds,
Yeah.
right? So I think marketing has also made people feel like they can do these things in no time, which it is like the perfect marketing approach. But the reality is there's a lot of dense space between where you are to where you want to get to, especially if you're a young man or a young woman. It just takes, and then you see other people, oh, crypto, he's a billionaire, and then he's 19, and and then that's confusing because that's not the whole world. That's like one person out of 30 million or 100
Yeah, and
million
they don't
people.
follow up. Same with
Yeah.
lottery winners. They don't look 2 years later and they're all broke. I mean, or 60, 70% because they're not used to handling that. And the same risk that went into getting there is the same risk that can help you lose it, which again is why real estate's such an interesting, stable asset because it's tangible. It still risks, but in my opinion, it carries much less risk than all these things that people are posting about, that have become more quick money. Do you agree with that?
Yeah, of course. I mean, I look, you can make a lot of money in an operating business, but once you make that money, if you look at any of these like large family offices, which is a fancy way of saying people with a lot of money, what do they do as soon as they make their money in tech or they make their money in an operating business or whatever? They immediately put a huge chunk of that cash into real estate because it is stable. And again, there's risk, but it's a different kind of risk.
Yeah, and if you do what we're saying and you build those relationships, become the cog in the wheel, your risk is going to be levered down at all times because you learn more. It's how you got up, like you were saying, you played every role. So when you got up to raising funds for yourself or even in the first partnership, you were way ahead of the curve and you also weren't trying to punch above your weight, which I think is important as well.
Yeah, and look, I'm not flawless either. I've taken my lumps. First of all, if you've been in this, I got to tell you this, I was at a conference a few months ago and a speaker said, who here has been in the business for less than 5 years? And a whole bunch of people with their hands up. And then the speaker goes, oh, that's great. You guys haven't had any hard issues yet. And people are like, what do you mean? And I'm just sitting there laughing,
Yeah,
right?
yeah,
Because it's like,
yeah.
it's all relative, right? Because you're going to take your lumps at some point.
Yeah, I think it's really important, especially when you're looking at syndications and funds to see what the full cycle value is and if they've gone through economic cycles that were challenging and how they had it. I mean, it doesn't mean that newer businesses operating in the space who weren't operating in 2007, 2008, 2009, can't do well. But that's a troubling time that when people got through or how they got through, or if they failed and raised back, is an important lesson for someone to take in terms of who they want to invest with.
Yeah, look, I mean, it just, you will at some point have hard issues, whether it's market driven or maybe some other issues and that's not so much in my mind, that not so much the red flag, but how you handle and conduct yourself through it is what's really, really telling, right? I mean, I know plenty of people that have had a really tough time in '07, '08, but have come out, 10 times, 100 times bigger now because of, they had the downturn, they learned the lessons, they doubled down on the right things, and now they're operating a much bigger business, a much more profitable business. And I also know people that the reverse of that is true.
Yeah.
'07, '08 knocked them out, and they're just like never wanting to get back into the ring again.
Yeah, and I think if you even look at the more recent struggles in syndications and funds, there's really two different types. There's a deal that goes awry, but it wasn't operator based. It was actually a financial asset. They were levered okay, but because of the dynamics, it just went down and caused a problem. And then there's just over realized, what they thought they could do, which is they bet on everything wrong, didn't have a good plan. And those are the ones that people should be more scared of.
Yeah, well, Jonathan, I don't know about you, but I've never seen a syndicator send me a pro forma that I didn't like.
Yeah, exactly. Yeah, right. It's not going out in an email if it doesn't look good. You're not getting a 1% IRR PDF of 20 pages.
I've also never had a pitch how I'm going to lose your money. Right?
Yeah,
So,
right. Yeah.
The point is everybody has, look, being optimistic is to some extent important, but I remember in 2022, 23, when guys were sending me stuff with rent growth of like 6, 7%.
Yeah.
And expense growth of like 1 or 2. I'm like, guys, and then cap rates, they're at 3,500 bips when they like, it's just like, I'm just like, guys, like, and then debt because the lenders are lending at 3%, 90%, LTC will roll your renos. And it's just like, guys, like this is a house on fire. We just haven't seen the match yet. And he was like, I'm like,
short-term
right.
thinking and no economic cycle history to deal with. Because if you had gone through other cycles, they would have known that you can't just, go on the last year predictor and think it's going to work.
I had one of my investors pull me aside years ago, it was 15, 16 years ago. Someone stayed in touch with. I remember I was walking him through a deal and, growth, next big, whatever, all the blue sky stuff. And he looks at me and goes, young man, I don't care about return on capital until you show me return of capital. And I just sat there and I'm like, that's deep. And I had to think about it because and I'm 22, 23. I'm like, oh, that makes so much, 40, 41 now. I'm like, that makes so much sense, right? Because it's just, but people, if you've never seen it, you think that things always just kind of, work.
Yeah. That's a really good statement, though. I hope nobody missed that because it's really important, especially with how you look at syndications and funds, even as an LP, what you want, when you're going to get it, and understanding the timelines of kind of what you're signing up for.
Well, that's how I look at everything. Every business I've bought, every building I've bought, any transaction I go into, I look about return of capital. How do I get my money back? How is that? How likely is it? So in other words, what are the different ways we can liquidate it? Not that we want to, but if we had to,
right.
What would that mean to me as an LP or as a GP or whatever? And then based on the ability to actually see my money back over what period of time would then help me determine whether the risk premium that I'm potentially going to earn from you on this transaction, whether the juice is worth a squeeze, so to speak.
Hey, it's Jonathan. I hope you're enjoying this episode with Marcin Drozdz. And as we're getting into it and you're getting excited, we have a special link for you. So when you're done or right now, take a break, go to the show notes and look for something that says special link. And then there's a link there and that relates to us. And there you can get the proven formula to connect with thousands of investors. You can raise 1 to 3 million in the next 90 days with Marcin's system. And then if you're interested, you can follow up, talk about the M1 Inner Circle, which is where the big guns go. Let's get back to the show. Yeah, no, I think it makes a lot of sense. Yeah, when I'm investing as an LP, I do I literally do your framework. It's people first. I'm on that jockey, really understanding. Then I move to the asset and I kind of do my own due diligence of the asset. Of course, I'm focused on just one property syndications because that's what I like. Funds interest me, but I'm worried about like the long term. So I'd love to get into that because it depends on really what your risk appetite is and what kind of growth you want. But I think that newer investors or people not familiar with passive investing, fund syndication, they don't get that there's a lot of nuance in every deal and a lot of promises out there. Like, as you said, a great point. No one's going to send you a PDF that is terrible. Every deal is supposed to look good. It's just about, can you do the due diligence to figure out where the holes may be and what you have maybe missed on the operator.
Yeah, it's true.
Yeah. So, what's some advice that you would give to people who are looking to think about fund investing where there's multiple properties involved in one fund? Because it's a little bit of a different structure in terms of return on capital, but still can give you a little bit more diversification than a one property syndication.
Yeah, sure. So, if you take a step back and you look at how the biggest institutional investors invest, they typically invest in fund style structures, right? So whether it's KKR, Apollo, Blackstone, name any of the large institutional guys, they typically do a fund style acquisition model. And the reason why they do it partly is because they want to have the leverage in the marketplace when they're negotiating a transaction. So, like the last deal I did, we raised the capital first in a fund style model. And when we were negotiating to make the acquisition, we were able to buy it for a significant discount because I could just be like, well, here's the bank.
We have it. Yeah.
And that changes the dynamics because as I know, when you're buying, you either get the terms or you get the price.
Yeah,
Rarely
yeah.
do you get both, right?
Right.
So terms means, hey, I need 6 months to close and like the stars have to align and all this stuff versus the price. Well, here's the price, right? So ideally as a buyer, you want the best terms, best price. Seller typically wants the opposite. So you kind of end up meeting in the middle, right?
Yeah.
So with a fund, what you end up being able to do is you can negotiate with a balance sheet. So that's really helpful. Now there's a certain level where it doesn't really matter anymore because everybody can write a check
Right.
at a certain size, but there's a sweet spot there. So I like funds for that reason. I also like funds because funds create an alignment on the actual team itself and on the process that the team is going to go through. And the portfolio leaves some discretion to the team, and as long as you're following your process, which is important, you can't say you're going to zig and then zag because that's just that people get in trouble that way. But the advantages of having multiple assets in one portfolio, as you said, is you can build a thesis around a theme. So, for example, my first fund was my first big raise outside of working with MC was a fund. Like I said, we did an 8-figure equity fund, and we bought. Our thesis was we were going to buy the medical plaza. So we were in Arizona. We were buying strip malls. The thesis was there's no financing in the marketplace, which was true. Everything we bought had to be cash. But don't worry, it's going to be a great deal because things are selling for pennies on the dollar because there is no financing. So, which was true. We were able to buy stuff for 20, 30 cents on the dollar. We bought in 11 and 12, I think. And then my only regret is we sold in 15, 16. I think we should have just held on to that stuff forever. Hindsight's 2020. We did well. So it worked. The point is it was a thesis driven. Here's the team, here's the thesis, here's where, and we're going to raise money. And then with that money, we're just going to buy stuff. There's advantages to that because we executed our plan and we were able to make really good offers. But the risks with funds is that if you're working with newer syndicators or newer people that are not used to running that kind of a model, then they can get themselves in trouble because the temptation is just to buy something because they have the money.
Yeah, exactly.
And that's not good.
Yeah.
Or in the extreme version, they do things different than what they told you they were going to do, and that's a big no-no in a lot of people's eyes. Also legally, it's a big no-no.
Yeah.
But there are pros and cons. There are ways to mitigate. There's various different versions of funds and mechanisms and things like this. But ultimately, the big differentiator between a fund and a syndication is a syndication. It's like, here's this project in this specific set of circumstances versus here's a variety of hopefully similar projects that are moving towards this type of model. The other one more, I guess, advantage of a fund is you have more flexibility from timing of cash flows, and you can do different things with 1031s and rollovers and all kinds of different things. And then also, if your fund is big enough, you can actually get the accretive benefit, which is just a fancy way of saying is you can pool your assets, and if you sell them as one, so imagine 10 syndications being sold to one big buyer. If you sold them all as a fund and they're all in a theme, you could negotiate a premium because you're selling them 1,500 units per se instead of 190 units.
Yeah.
So to speak.
And there's a lot of corollaries, though, because you mentioned 1031 for a second, but when you were talking about new fund GPs sometimes making the jump too fast, I was thinking of, 1031 people who, they do the 1031, but they identified 3 properties they don't even like. And then they're just like, oh, well, I'll just get one because I kind of have to, which is why I've
Yeah,
never been a huge fan of 1031s. And I can see that a lot. But one thing that I'm getting from you on the funds, that the first P of your framework is really, really more important even in a fund, because you're kind of waiting for something. When I'm looking at a one-off syndication, the assets there, I can look at it myself and really judge like outside of the pro forma. Like, hey, I mean, I can pull it up on Google Maps, like, oh, this is
yeah,
a 2020 build. But in a fund, need more trust, because you're like, hey, you're going to give us some money, then we're going to go find the products. And like you said,
yeah.
we're going to try to keep them diversified, which does give you a great opportunity, because then something can go wrong. Something goes wrong in your one-off deal, you're in trouble. If you have 8 different things in there and different asset classes, you're really kind of leveraged together to be safer.
Yeah, and the other thing you can do in a fund that you can't really do in a syndication is when you do a cash out refi within a fund, you can just keep rolling and
Yeah,
compounding.
right.
So, and there's so for example, a fund, let's just say you have a 5 to 7 year window, or let's just say 7 to 10 year, just to be ultra conservative. You spend the first year fundraising and doing due diligence on assets. And then you spend years, call it 0 to 1, technically doing that, or 0 to 0.6 or whatever it is. And then you spend the next 6 months to a year potentially deploying all the capital. And the theory and the thesis is that because you have the cash, you can negotiate much, much more aggressive terms, which has definitely been the case for me, and other people I know. And you make your money when you buy, and so that's a big thing, which is really helpful. And then then you spend the next 2 to 3 years really seasoning the asset, and then you may be able to get a liquidity event or refinance within that period of time. And you can typically roll that cash and compound that cash. Again, there's tax planning and things you got to
Yeah,
do with
yeah.
your LPs and whatever, but you can net get a much better return if the operating team knows what they're doing. And you don't have to re-raise the capital multiple times. You can typically cycle the money twice, maybe 3 times within that window.
Yeah, I mean, for me and what I've learned as an LP in these situations is I'm really trying to create a snowball that I don't want back anyway. I mean, that's kind of the whole
Well,
point.
that and that's exactly why people do the fun thing, because
Right.
as an LP, like I can't tell you how many guys I know that write big 6, 7 figure checks, and I literally just hit him with a refi a few months ago. We just refied an asset, a couple $1 million went back, and this wasn't in a fund, and then they're like, "Well, what do you want me to do with this?" I'm like, "Well, it's yours."
Take it back.
I was like, can I give it back to you? It's like, well, hold on a second. I got, like, you see what I mean? Like, it's just,
Yeah.
so you might as well, if you have that trust and credibility with people and they're not going to need the money anyway, then there's a way to do it. And then, of course, the other version of a fund is a debt fund. So we have plenty of clients that are builders, developers, and they're tired of paying hard money or trying to feast or famine for every project or lot or whatever it is. So instead of paying 18 or 16 points, they just have a debt fund that might be a couple million or 8 figures or whatever it is, and they're able to they have their own governance controls they have to follow, but ultimately they're able to create their own liquidity for their business model through a different type of a fund
Yeah.
by issuing debt.
Yeah, debt funds are really interesting to me. I had somebody on, I don't know if you've ever heard of it. I hadn't heard of this before, and he had a debt fund that just funded trial lawyers for huge trials. It was really interesting to me. But debt funds really make a lot of sense because when economic upturn is there and banks and rates are going up, private debt fund can dictate their own terms. And it's kind of a much more, as we're saying a lot, this person to person relationship instead of a person to large scale financial institution relationship, which almost none of
Yeah.
us enjoy.
Yeah, no, I've seen several debt funds. I've been part of building a few, both inside of real estate and outside of real estate for various assets and collateralized, things and contracts and receivables. And yeah, debt funds are a different, it's uh, let's just say it's for a different avatar. Like
Yeah,
someone who would buy
exactly.
somebody who would buy a debt fund as an investor, the pain that they're trying to resolve, because everybody has pain that they're trying to solve for. I think that's kind of my theory. And a debt fund investor is typically a high paid W-2 that's trying to get out of their 9 to 5. And maybe they're trying to put their money to work so they can replace their active income with other income, right? Versus, my buddies, guys that have sold companies and have businesses, they have tax issues.
Yeah, yeah,
That's a different human. They don't need they don't need more income. They're good on the income side.
yeah,
They just need ways to reduce their tax burden, right? So but that's another thing. You got to be mindful of what problem you're solving and
yeah,
for who, because, I've seen it before where people will structure debt funds because they think that that's, the hot, the hot take for now. But then they go to their network, which is full of people that already have tax issues
right,
and they don't
right.
want more income. And well, that's a mismatch.
Yeah, does that play a role when you're in the inner circle when you're training people to really work on their capital raise? It's like not everyone's not a good fit for your raise, and when you know that, you become more trustworthy by not trying to force everyone into the same thing. Say if once you tell someone, I don't think this is going to work for you, and that this is why. I feel like they're more likely to come back later than somebody try to just get into, when you're just trying to funnel everyone into one thing.
Yeah, 100%. I mean, one of the things that we've built out, and for context, Jonathan, I've trained thousands of financial advisors on this as well because we've done capital raising through the investment brokerages and they've sold our offerings and whatnot. So one of the things I did to encourage them to do more is I taught them how to actually get their clients to say yes. So I showed them how to do that. Right now, obviously they have to follow their own rules, but I have a thing called the upfront contract where there's a way to just maintain your frame and not be pushy, not be salesy, and ultimately you're just trying to figure out if there's a fit. They're interviewing you, but you should also have the mentality of, is this person a good fit for what I'm
Yeah,
doing?
yeah,
And if they're
exactly.
not, yeah, I've done it 10, 15 minutes into the meeting. I said, hey, listen, it was really good to meet you, but we can grab a coffee, but what I'm working on just isn't going to work for what you're doing. So if you're good with it, we can just kind of turn the page. Well, no, why isn't it fit? Well, you told me this and we do this. Oh, and then one of two things will happen. Well, no, 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 I actually don't need that. I'm
Yeah,
open
yeah,
to whatever. And that's fine. Then we're having a very transparent conversation. Or they're going to say, you know what? I appreciate you saying that. And then those people, because you've done right by them, well, I can't tell you how many people I've had people refer people to me because of that.
yeah. I agree. I vote. So one of my principles across my entire investing career has always been that the biggest power you have as an investor is the ability to walk away, and this is tied into that. It's almost the same as the ability to say no. You're not so hungry that you want to take on bad dollars or someone who's not really the right fit. It will come back to haunt you if you take the wrong fit. If you have someone who wants a shorter term cycle and they're thinking 3 to 5 years, and this is a 7 to 10 year, they're going to be the pain at 3 years, and it's going to be your fault, right?
Man, oh man, a bad investor is like buying a boat. Okay, you're only gonna like it the day you bought it, and you're gonna love it the day you get rid of it.
Yeah.
Okay, it's gonna be,
Yeah. A
you know,
couple
and
days when you're in the middle of the ocean and it's
yeah,
not breaking down, maybe, but that's about
yeah,
it.
yeah. No, and listen, I have a saying: if you chase money, it will run from you.
Yeah,
So,
that's great.
literally, like if you push things onto people, those things will be repelled from you. And it's especially with investors, if you can tell you're not aligned, just be like, hey, I appreciate, like in your case, I appreciate, that you want a 3 year window. This just isn't going to work because we're probably 5 to 7 years out. And
Yeah.
then just see what they say.
Yeah, exactly. Like you said, they could come back and say, actually, let me rethink that window. And then you've intentionally not pressured them into anything. They're going to rethink what their opportunities are. Maybe they still pass. But as you said, much more likely to get referrals, which is really the lifeblood of funds and syndication investors because they're already vetted by somebody else who has invested with you. So you're like, oh, they're trying to put someone good and you're still going to do your due diligence on them. But that's really where your funnel is built person and then to person outside of that as they talk to each other.
Yeah, and you know where a lot of guys get it wrong online is exactly that. They think that going online, you're just going to find people off the internet that are going to meet with you, one call close, and write you a check.
Yeah.
It's not how it works. I
No.
mean, look, the online game is a long-term, just make someone think, make someone curious, make someone maybe laugh, and then they'll start to engage. Be like, oh, I kind of like this guy, or I kind of like this girl. Like, what's their deal? And then they start to maybe Google you or now Chat GPT you or whatever it is, and they start to look, and then they kind of go, oh, okay, cool, and then they forget about it. Maybe they see you somewhere else a month, 2 weeks later, and then they start to engage, and maybe you have like a book or a conference or a webinar that you're speaking at or something like, hey, I actually want to see this guy, see what she's about or see what he's about. And then on that third or fourth or maybe 20th interaction, they'll be like, okay, well, let's book a call. And that is literally that by the time you get on a call with someone that's already felt like they've seen you and they can say things back to you that you've said that you don't even remember saying anymore, but you obviously said it. That those are the people that show up thinking, how much and when they're going to invest, not if.
Exactly.
And that's super powerful.
Yeah, and those calls are great, but it comes from authentic social media and use of just being out there, being the person giving information. So, like as we were saying, no one feels pressured. They can watch videos on YouTube for a year, but as you said, when they set up that call, they're dropping the money. They've like done the research for 2 years. You don't even know them, but they know you. And that
Yeah.
is the kind of good of social media. It's just that if you're authentic, you can get past all the inauthentic stuff. To a lot of us, it's obvious what's fake, but it's getting harder and harder to tell, especially for people who are kind of newer to something that they're also very excited and they feel like they have to do. Like, hey, someone told me it's time to invest. They want to invest. They maybe jump too soon.
Yeah. Well, it's also important. I know you know this, having been in the business for as long as you have, is that there's a lot of people that are going to want to pick your brain, especially while you're in the middle of a raise. And there's nothing wrong with that, but being clear on your priorities is important because you have an obligation to your existing LPs, to your shareholders, to your partners, to whoever it is, to stay focused on the goal. So, as much as I like giving and spending time teaching and educating and sharing and whatever, if I'm in the middle of a race, like that's why I have free resources that you
Yeah,
can just
right.
absorb because like the 2 hours you want, I'm happy to give you, but it's going to be later
Yeah,
because right now I'm kind of busy. So
yeah,
you need to have and I'm not saying you avoid people. I'm just saying you create an environment where you don't put yourself in scenarios where you suddenly lost 6 hours of your day and you don't really know what happened.
yeah.
Right. So
Uh,
you got to create environments.
Yeah, it's a great point. And then that's another content creation. If someone asks you a question over and over, you get multiple questions and then you make a video about it, you can just send the video. That's what I do. And then when you have the follow-up conversation, you're up a rung of trust, which is a lot of what we're talking about, how you keep going up from level to level. Yeah, I mean, real estate's an interesting game. People always think that, oh, it's so big. But once you get inside these circles, it's very small. Everybody seems to know everybody the further you get. And that's why bad dealings inside can really, take you out of the game pretty quickly.
Yeah, well, what you're saying is so true. I mean, literally for me, when M1 Inner Circle, we started it by accident. It was literally COVID. I'm at home. I'm not.
Yeah,
'Cause
yeah,
I used to be like on a flight. I don't know, 200, 250. This was before Zoom and before
yeah,
all
yeah.
this stuff, right? Like I still remember Skype, or as my mom calls it, Skypey, right? And just like I still remember Skype, and and nobody used it because you like, what do you mean you want to Skype? You don't want to come see me? Just
Right.
come see us, right? He's
Yeah.
like, okay, well, that's what you did, right? So during COVID, I'm at home like everyone else, learning how to make bread, and in between, in
Get you a lot of
between,
sourdough. Yeah.
yeah, 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 this, it. We learned a lot of. I learned how to cook. That was true.
Yeah.
But besides that, I'm at home and my buddies are texting me and about deals and things. Hey, got a minute? Got a minute? Got a minute, guys? So finally, I was like 20 of these things, and I'm just like, all right. everybody come on a webinar. I literally figured out how to use Zoom. I'm like, hop on this webinar. Here's my link. I'll answer all your questions and then we're good. And I thought I'd spend 2 hours on this webinar, answer everyone's questions, and everyone would leave me alone. I was there for like 6 or 7 hours. We took a lunch break. We came back. My wife's like, "Are we still going out for dinner?" I'm like, "I don't know." And I just answered because yeah, a couple hundred people, and everyone. It was weird too because I wasn't used to like speak. I guess speak on stage is fine, but like it's like at your home in a monitor,
Yeah,
like all the
all the
eyeballs.
faces and
It
everything. Yeah.
was so weird, right?
Yeah.
But anyway, so I'm just like addressing people's individual, like I didn't know how to conduct myself. Like I didn't know the etiquette, right? So anyway, I'm answering everyone's questions and one question open another, and then I end up going down these spider webs because I thought I would be able to give you an answer, but then I have to explain that before I could like you have to give the context of the context. It's just so anyway, fast forward, I'm like, okay, cool. So that's cool. And everyone's like, hey, can we do it again next week? So I'm like, so we we start meeting once a week. I'm like coming off like an hour or two on like a evening. Then finally I did this for like 4 or 5 weeks and I'm like, wait, if I just build a course, they'll leave me alone. That's what I thought. So I'm serious. My thought, I built like I created like an outline for a course. I didn't sell it. I just gave it away. And
You're
everyone's
like,
like,
oh, I
okay,
got
can we
my
now?
time back.
Yeah, no, I did not. And then they're
Yeah.
like, okay, let's do the course. Let's talk about it on these calls.
Right. Now let's do 2 calls a week.
And it did, because then they're like, well, what about this? Anyways, it turned into something. I finally look at my wife. I'm like, I think I got to charge these people and they'll leave me alone. So I threw a price out, a couple $1,000. People are like, okay, no problem. I'm like, all right, well, with the money that we got, I didn't know, I wasn't thinking of it as a business. You understand? Like I was just like trying to create, like, I was trying to get my time back to do what I want to do because I didn't want to say no, but I was just trying to say, like, create like a barrier, right? And anyway, fast forward, it's, what do I know? We've had over 1,000 people within our community. Our clients have raised a lot of money. They've done a couple billion in their own deals with the money that they've raised, and it's been fun, but it organically happened. So my whole point of my long rant is the people that are following you in whatever context, whether you're a new syndicator, fund manager, or raiser, you don't know when they're paying attention to what. But if you just stay authentic, like you said, to what you have expertise in, then you will get noticed for that thing. And it will blossom into ways that I would have never imagined today that we would have had what we had on the training side and the consulting side, in addition to our actual business side.
Yeah. Awesome. Before we hop off, I wanted to talk to you about what you like your asset allocation inside of your funds. Do you have preferred assets that you're like, hey, we need to have this in there in terms of multifamily or self-storage, or is each fund a different makeup depending on what investor sentiment looks like at the time?
Yeah. So the last fund I did, and probably the next fund I'm going to do is going to be just multifamily. I'm going to keep it clean. I am kicking around the idea of a debt fund as well, just because I did a debt fund. It was $70 million years ago. It was actually outside of real estate. It was commercial financing,
Oh, okay.
like actual equipment leasing and things like that. We consulted on that. We helped build that fund out. So I do have opportunities in that world again, but it's a little early, and I want to see what Trump does with the rates, because if Trump drops the rates again, those private lending funds are going to become a boom again, because the discrepancy, the delta that you can pick up between the T-bills and the market rate, that'll make private debt funds even more attractive, believe it or not. And on the multifamily side, I did a fireside chat with Ken McElroy, my mentor. He was at my workshop a few weeks ago. And one of the things that he and I were talking about is this $1 trillion debt wall that's coming. And it's due, well, it's actually happening now. We just don't hear about it yet, right up until mid-2026. Kenny's of the opinion that there's going to be a lot of commercial assets, a lot of about 800 billion of that, I think, is multifamily.
Yeah.
Or 700, a good chunk of it is multifamily. And so he's got this theory or thesis that there's this window of about 12 to 18 months between when those deals go bad to when the institutional guys come in to step back into the market.
Yeah.
So that's what he's positioning for right now. And I'm very much paying attention to that too.
Yeah. Awesome. Where's the best place for people to get more info? I think we have a link for them also, but is it at your website, marcindrozdz.com?
marcindrozdz.com, MARCIN DROZDZ.com. And then we've got, for those of you who are syndicators or fundraisers, I have a best-selling book called Unlimited Investor Leads, How to Find People with Money. If you want a copy of that, you can grab it on the website. It's free.
Yeah, awesome. Well, it's been a pleasure. I really enjoyed it. I love talking capital raising, real estate investing. And can people find you on social as well?
Yeah, Instagram's probably the best place. realmarcindrozdz.com. Not .com, but real Marcin Drozdz, whatever it is. There you go. Shows you how old I am. And YouTube, I think it's real Marcin Drozdz as well. We've put in an effort in the last maybe 6 months to really put out some really good content. We have a team working on that, so there's really good, consistent videos coming out on YouTube now as well.
Yeah, great. Well, I really appreciate you spending the time and look forward to staying in touch.
Yeah, it was a lot of fun. Thank you, sir.
Yeah, all right. That was Marcin Drozdz. You can find him at his name. He already spelled it for you. MarcindRozdz.com. That's where you can get all the information, find his book. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around so you can get a preview of who's coming up on episode 299 of Zen and the Art of Real Estate Investing, and it's Benjamin Canner of 3V Infrastructure. This is a new type of show for you. I hope you're ready. Real estate portfolio owners of long dwell locations hold the key to EV adoption. Yes, that's EV chargers. While property owners understand the importance of EV charging, building EV infrastructure at scale in many cities and utilities requires significant capital, time, and a deep understanding of the EV charging ecosystem. We go all into it with Ben Canner next episode.